Good day and welcome to the Experian Innovation Summit. My name is Vusi January. I'm the head of analytics at Experian SA. Today, I'm here to talk to you about how to proactively manage customers in distress by identifying debt review early using our debt review scorecard that we recently developed. The journey that I'll be taking you through will be highlighting the recent trends that we see on debt review. That is, people that are constantly applying for debt review over time in the recent months compared to the previous periods. We'll also be looking at how that debt review pool that is coming in is distributed by our Sigma scorecard, the risk band of that scorecard, and also using our financial affluence segments, how in terms of the life stages and income debt review applications are coming from. And again, if you look at the vertical markets, the banks, the retailers, the micro lenders, personal loans, how and where is the bulk of debt review coming from? We also started to look at the average debt review, where we wanted to just see, is the average balance that is going to debt review growing, or is it consistent, or is it staying? Is it higher than the debt review, the average balance of a active base? And also, as a percentage of the active base, is the debt review population growing? The next step, when we designed that, or when we looked at those trends using our recently developed benchmark, we decided to start now put together a scorecard that we can develop to help identify debt review. So I will be taking you through the methodology of that we used and the approach that we've used to develop that scorecard, the genies that we got from the scorecard, which are really good genies. But again, we'll see the test in there, it will be in the pudding by taking populations. We'll also take you through the benefits of using the debt review scorecard. Given the current credit landscape, I think it's important just to understand across the credit life cycle what are the benefits of using this scorecard. And lastly, where can the scorecard be used in the credit life cycle, and how can it be used to actually help identify slots and segments that can be treated differently? Recently at Experian, we actually developed a debt review benchmark. This started with the ask from the banks, where there was worry of how of the increase in the debt review, number of inquiries and accounts that are going to debt review soon after taking on loans or credit cards or even buying assets, which is really alarming because even before much payments actually made, the big balance is now becoming the balance that is at risk, that is going into default very early, which is really alarming, both from the write-off point of view and also from the provisions that need to be done for new accounts. Obviously, also existing accounts are starting to go into debt review, and you'll see later on, these are clients that are normally really good at paying their debt. The willingness to pay has always been there and it's always been maintained. But now, because of the changing landscape, the changing economic factors, people that used to afford are starting to be feeling the pinch. They're starting to be in a corner. The headroom of what has been available in their wallets to make these regular payments has started to decrease. The reason for that, I'm sure you've all seen within your personal finances and within the portfolios that you're managing, there's been serious increase in interest rates. And these have started to actually affect the secure market in terms of vehicle finance and home loans, because these are the guys that are actually interest rate sensitive. When those changes actually happen, then especially when they're in the rise, they actually put a lot of stress into people's wallets. And that's what we started to see, and that's what the banks are really worried about as well. The rise in inflation is actually starting to affect now the guys that are using a lot of of the unsecured products and within the retail space. The reason for that is because The inflation is now reducing what the guys are able to afford. The interest rates within that space were already at max, and now even the inflation is actually putting them in that corner, so making things even worse. As a result of the default rates that are growing as well in the industry, we see that companies are starting to cut response, so accepting less people because they're trying to minimize what is at risk and what is the exposure at risk. As part of that strategy as well, when you identify accounts that are starting to default, naturally your next strategy is to try and reduce limits on your limit management strategies on a month-to-month basis. Both those factors are putting pressure on clients where they used to have limits available to utilize as part of their month-to-month living, to utilize as part of their household management um, assets that are available. And now, when those reduce, they put more pressure on what they can actually do as a decision, and they start to look for alternative solutions in the industry. And that review currently is becoming that solution. It is well advertised. It is advertised as this beautiful thing that people can actually use to take them out of distress. And it's just important for everyone to identify those um, clients very early, such that you have more control of what you can do. You are proactive in your approach of what you can do to minimize the impact of debt review and the reduction of those cash flows. We'll see an increase in unemployment. The labor force is actually now reducing, meaning as people go out of unemployment, they don't have any choices. It is important that you're the person that gets in there and be the solution to those clients. Because again, like I said, we know that if you look at the history of these people, of these customers, the appetite to pay is always been there, the willingness to pay has always been there, but now the corner they've been put in is really the one that is making them make decisions. Let's get in there and try and identify the clients and try to help them and be the solution that is needed in the industry. Salaries are really sticky upwards. I'm sure we've all seen this happening. We know no one is actually able to give big salary increases these days. That's just due to profit margins have also reduced across the different businesses. If the bad rates and the write-offs are increasing and the books are not growing very well because of debt review, obviously profitability becomes less, and the pot that is supposed to be shared with employers reduces as well, such that those salary increases are not as big or as significant as they used to be. In some cases, as mentioned, they're actually even less than the inflation rates that we see annually. And just lastly on the side, we see that on a monthly basis now, the number of inquiries that we see for people seeking for debt review is actually sitting about 12K a month. This used to be averaging about 10 in the last 3 years, and now we see a growing trend, and it just continues to grow. Just to also make sure that we're looking at the debt review in a ratio view, so we don't looking at just a natural growth of volumes of debt review. We started to look at the average debt review when you compare it to the active base current average balance. We can see that over the last 4 years, just the average debt review has been growing, which is similar to the average balance. It's slightly been growing as well. The problem is that the average debt review balance is growing much faster than the average current balance of active accounts. So that should be worrying as well, such that what is at default, what is at exposure at default, is seriously growing faster than what is actually good accounts or performing accounts. Similar, when you look at the debt review as a percentage of active balances or the percentage of active accounts, you can see that the rate, that gap is actually now increasing. So which means you're having more accounts that are coming from the active base to be coming into the debt review space. You might say, well, in my portfolio, debt review as a percentage of my accounts is small, but what matters is that it is growing and it needs to be minimized very quickly, as it puts a lot of pressure on the risk. We started to look with the benchmark that we've created we looked at now how is these guys that are in debt review and applying for debt review, how are they distributed across the risk bands that we see using our Sigma standard scorecard as a base of measure. And we see that at least 64% of the accounts are actually sitting in the mid to high, sorry, to low risk scoring accounts, meaning that the pressure is no longer a pressure that is sitting in the high risk space. It's starting to affect guys that are really good scoring. Again, like I said, when it comes to interest rates, the guys in the secure space that are sitting in those high risk bands or low risk bands, basically. Those are the guys that are actually starting to suffer from because of interest rates, and we still have a good distribution in the high risk bands because of that pressures of inflations that are coming through. If you look at our financial affluence segments, where we measure the distribution of income of our clients uh, in, together with their life stages and where they aspire to be, clients that used to be money conscious, majority, the stable spenders, the aspirations, the biggest distribution now is sitting in those guys. Again, shows to that it's no longer a problem of struggling individuals or people with low income. It's becoming a problem across board, across income, across even industries. When you look, when you start to look at our vertical market distribution, we know naturally from the home loans, just where you're gonna get a big percentage. We've seen that happening, but now with the problem that within those those personal loans, not home loans, within those personal loans, there was a group of guys that were really good, but now that distribution is becoming blur, where across the distribution of personal loans, you're getting people seeking debt review. Retail, similar situation. We have more accounts that are seeking debt review within the retail space, and the distribution again of risk is now across and is growing. Same with revolving credit. But what is interesting is that we have a 13% at account level that is just sitting, that is debt review that is coming from home loans. So again, the picture is just saying debt review is not something that is looked at as something that targets people of high risk or low incomes. It's something that is across. So after seeing all those trends, and again, if you're interested in the benchmark with full benchmark where you can actually see all these trends against your peers, against different industries, you can actually talk to our account managers and we'll help you get to understand the full spectrum of those trends. But when we saw that, we actually decided to do something about it as Experian, where we decided to build a debt review scorecard. The debt review scorecard that we built is a thick file scorecard, and it was built with an outcome flag of trying to predict what is the likelihood of an account that is active to go into debt review in the next 3 months. Focus also being a short outcome period just to make sure that we identify these very early and we create that early warning so that we can be proactive about what we do early enough. The model that we used, the model approach, we use a logistic regression approach, which is a standard approach to build scorecards. And it's something that we've always trusted and used. We do have machine learning techniques that you can use, but for this scorecard, we specifically decided to go with just the traditional logistic regression. The development period that we utilized was January 2019 to June 2021. That period covers the COVID period that was observed across the country, and it also just looks outside of that period with an out of time of July 2021 to June 2022. The score was built on two segments. We created one segment that is a clean segment, and the second segment was a dirty segment. The clean segment is looking at individuals that are currently up to date on all their credit lines that they have. And what is their likelihood? If they current today, what's the likelihood that in the next 3 months they will be going to debt review? And that is a big problem, because if you have that increase of people from an up-to-date space to debt review within 3 months, it's a serious problem, because you're moving people from a stage one where on average, with understanding provisions, on average those guys will be provided for at maybe at 8%. Now, when they move to debt review, you have to move these accounts to stage three, and at that point, you have to provide for them at something that is 88% to 90 to 100%, actually, even for some people, immediately. So that is something that you really, really want to watch, because it hits the bottom line immediately. The dirty segment, again, still serious challenges there. If someone is one plus and is likely to go into debt review in the next 90 days, you still have the same problem where someone that was in stage two has to immediately move into stage three. And also, it's going to affect the cash flows and increase the provision significantly at an account level. The two models that were built, the clean and the dirty segment, we got really good genies that surprised us. At the dev, when we're doing the development, we got a Gini of 77% or 77 Gini points. And when we tested on out of time, the Gini slightly improved to a 79%. Similar to the dirty segment, we got really good Genies in the mid to upper 60 points. And the reason for this is really, when you don't know an account that is up to date, and that account is likely to go to an extreme stage of debt review, then that gives you a good separation of risk, because it's something that you wouldn't have known before. But for this, I know that people can worry about the model fit when you have big genies. But what we're saying is that the proof is in the pudding. Give us the data, give us your population, so that we can test this information on your population and see what genes we get for your population. But also, we can now retro the population to 3 months before, where we say, at this point, we said these are the guys that are highly likely to go to debt review, maybe 80% likely to go to debt review. And we want to see how many of them 3 months later really goes to debt review. And that's where you actually be able to see the power of the scorecard that is built. Uh, and that's basically the ask that we have at the end of these presentations, that give us an opportunity to actually test your population, so that we can prove what we're talking about, and be able to become a solution in the industry and a trusted partner when it comes to all these rising challenges in the credit industry. Why would you want to use this debt review scorecard or this debt review model that we've built? Well, you need to be able to identify the potential clients that are in distress early on, before they even go to debt review. You need to be able to reach out to them and offer some solutions before your competitors go and actually talk to them. This now creates not just a solution for you and the client, it also builds loyalty. Because if I'm listening to an advert that is asking me to do debt review, and I know debt review is actually a very negative thing to do for my credit profile, and my provider comes to me in advance and actually offers a solution that can take me out of this space that I'm in terms of my finances, and not and struggling to figure out what do I drop, what do I lose, and while I want to keep everything, and then you become that trusted provider for me, it creates loyalty. Even later on, when things have actually resolved, you're the guy that I want to be able to do business with continuously. So it is really important to identify these guys and be a solution to their lives. And also, you understand that if they go to debt review, it really has a big impact on not just your profile or your portfolio, but on their lives as well. So be that solution for your clients by identifying early and be able to talk to them early. You're able to offer payment relief agreements before debt counselors do. Because if you don't do that, you create a situation where you'll have reduced cash flows, which you can avoid if you get in there early enough. With a debt review or debt counselors coming in, the installment can be reduced as much as like 90%. of the installment. Someone that was supposed to pay 1,000 rand can now go into debt counseling and be able to just pay 850 rand. So to minimize your reduced cash flows and to minimize uh, uh, wasting your net present value, and to also try not to keep clients in a space of not being able to purchase for a long time. Get in there early, talk to them, offer solutions, and make sure that it's a mutual agreement that is beneficial both for you and the clients. It also, with debt review, when people go into a debt review and they have a debt review flag next to them, which means for those retail accounts, they're not in a position to actually purchase. For those reloans, they're not in a position to be able to reloan. So they can't even get new products. What that means is that now the book itself is going to reduce. The active book reduces. The potential to purchase reduces. New accounts would also reduce. So now you have a book that is shrinking over time, and you have these big provisions or write-offs that are coming as well as the results of bad rates that are growing. And now that is a shrinking book that you have in terms of an active and performing book. So getting in there early again helps you to manage your portfolio well, while it still can help the client as well. I've mentioned this a couple of times, where your provision line, you try to protect it as well. So this is not something that is done just for a client. It's really something that is done for your business as well, to make sure that your bottom line remains stable. It's also important to just understand your clients. Before, we used to see a debt review trend of a certain percentage, and that was before COVID and just post COVID. What has happened now with the growth is that there's people that were willing to pay that are now falling into that pot. So when you understand them early and offer these solutions, you're able to split the guys that really want help, the guys that still have the appetite to pay, versus the guys that would have gone to debt review anyway, that are just inherently bad. And it's important to save the guys and salvage the ones that would have wanted to pay you, and then create that loyalty while building for the future for those guys as well. The debt review scorecard can really be cross-tab across the credit life cycle with any scorecards that you have in the business, so that you can find finer pockets and make finer decisions about what you need to do. I'm saying finer, but it usually is big chunks of those populations that actually can be identified with debt review as well. It'll just help you make better decisions, and treat your client base even better. And how and where can we use the debt review scorecard? I think I've mentioned that it is a scorecard that can be used across the credit life cycle of the business. In account management, it will help you to be able to manage the credit limit increases of the client. Basically, when you have your monthly credit strategy that is running, you want now to minimize doing that to clients that are likely to go to debt review in the next few months. Otherwise, and that will help you to minimize the potential balance that could be a risk in the recent future. So by having the scorecard, you will just be able to exclude those accounts, so that your account management and your credit limit increases is within the guys that really can afford and will continue to afford for a good future. Similar, it helps you now to take those buckets of accounts and be able to do them in your monthly credit limit decrease strategy and put them there, so that you minimize the exposure of the balance at risk, by making sure that over time you actually reduce those balances. Maybe in the next 3 months, you could reduce those balances that are not highly utilized at the moment, with good reductions, and minimize the balance at risk in the next 3 months. For marketing purposes, you don't really want to talk to guys that are likely to go to debt review in the next few months, because what it does, one of the things that we see in the industry is that there's a lot of people that go, they see marketing and they go and take the products, and then soon after taking the products, they go into debt review. It's a trend that has been growing. We understand what is happening within that trend as part of the strategy within the debt review space, but we want to be able to identify that early, so that we don't need to market to those individuals, then we don't market to those individuals, and not create that appetite for our products before they just go to debt review. Within the early and the late early and late collections, it's important to know who's going to go into debt review so that you can accelerate your treatment. So accounts that are looking as up to date or in the areas bucket less than 90 days, you want to be able now, if they are in debt, if they are likely to go to debt review, accelerate that treatment. Excuse me. Accelerate the treatment that you're going to give to them. But most importantly, be able to offer other solutions like restructures, forgive and forget strategies, or delaying areas with arrangements that can help you just manage the book well while keep accounts in the active status for longer and making sure that your book is much healthier. Talk to the clients, make sure you create that awareness and you create that loyalty that can come from just bringing solutions before the solutions come from the debt counselors. In the acquisition space as well, when you do limit assignment in that space, you don't want to accept and give big limits to people that previously are seen as good, as we saw that now debt review is coming also from the good scoring guys. You don't want, if that person is likely to go into debt review, um, give them big limits such that in the next 3 months those limits are now in debt review. That won't be a good business decision. So if you can identify those accounts early, do that and make sure that you minimize your exposure, or even do more validations and more checks on these people just to understand that you're not putting money that is already at risk in a very high rate. Again, this should help you prioritize your customers across the credit life cycle and be able to talk to them and treat them differently. Just lastly, one of the things that we saw just outside of debt review, guys that are identified as debt review, we also see that there's accounts that are sitting in our close to 500K that have been identified as overly indebted. And these are the guys that, even though they not do not have a debt review flag yet, or the debt review is not finalized for them, but these are the accounts that are highly indebted or overly indebted, and these are the guys that have very high propensity to go into debt review. So there's stuff that we see already, but the stuff that we know outside of just what is identified is really a bubble that is likely to go to debt review soon enough. Thank you for listening to my presentation. Should you have any questions, please put them in our chat panel and we'll get back to you as soon as possible. Thanks again.
Hi everyone, my name is Razia Cleland. I am a global consultant at Experian, and I'm here to talk to you today about a customer-centric approach to collections in the digital age. We'll focus on two aspects, the one being around customer journeys and the second being around digital enablement and what we can do to actually assist customers. So let's get started. So just a quote to kick us off: lose an hour in the morning and you'll be all day hunting for it. The translation of that is debt collection begins on day zero. So let's understand when we talk about customer journeys, really what we see a lot when we visit clients is that we are treating this different people as though they are the same. So all of us typically segment our non-paying population into delinquency buckets, so early stage all the way through to post write-off. Depending, different people might have different timings around these, but it's generally the same 5 stages that you see here, or 5 or 6 stages. And we cycle them through from early stage to mid stage to late stage. We receive a report or a feedback cycle, we make some adjustments, and they keep going round and round. So really, Einstein's quote is very relevant here. Insanity is repeating the same behavior and expecting a different outcome. So we want to move away from that. So what happens if we stay doing that, and many of you will be familiar with this frustration, is it causes a lot of operational and strategic challenges that can be very difficult to unpack and very difficult to overcome. So the first thing that happens is that you have a very top-heavy agent workforce. Because there are the most accounts at that stage, you need the most people to dial, so the logic goes. The next thing that happens is that your customers get stuck in this loop. So your bad customers know how to take advantage of that. And your good guys end up feeling very, very frustrated because they receive this, what feels like very harsh treatment after they've received very nice treatment, possibly. So that's not a great place to be in your customer journey. It's not great for retention. It's not great for maintaining goodwill. The third thing that happens is that your feedback loops are typically very slow, and they happen retrospectively because we have to wait for things to play out. We have to see if the strategy works. We wait for reports. We make adjustments. Those take time to test, implement, and deploy. So really, we are always playing this catch-up game, which is not ideal and not efficient. And then the last thing that happens is that we have possibly fallacious conclusions when we go to analyze the reporting. We tend to think, well, it's a quality issue. We have bad quality customers. Instead of thinking there's a behavior that is driving this, how do we understand that a little bit better? How do we become front foot in the problem? What we should be doing, and this at Experian is our passion, is using our analytics and our data tools to our advantage. So you can still have your customers start at the same point, and if you imagine the gray blocks as the possible set of paths that they could travel along, they can start at the same point, and we can still segment by delinquency buckets. But what we can do is overlay specific tools or segments or models that allows them to follow a tailored path for them, so that we can tilt focus, we can change our staffing, we can become more efficient, change scripting, so that we still focus on maximizing things like rand value collected or RPCs, etc. But we do that in a way that feels very empathetic for the customers. It feels very personalized because we've taken the time to have a look at who they really are. This approach, where we create this very tailored, hyper-personalized treatment path for them, is what real customer centricity is about. So when we think about a traditional approach, we typically only ask two questions, and those questions are what and when. So let's use a hypothetical example just to cement it and make it a little bit more realistic for everybody. So I apologize if anybody is called Victor or Sarah. It was an unintentional use of the names just for the sake of examples. We are not picking on you in any way. So let's consider Victor, our first person. So Victor is a low-risk, inattentive kind of guy. He is what you would call digitally native. Quite a young guy typically. He likes digital interfaces. He'll respond to messaging, but he doesn't like taking phone calls. Cue Gen Z millennial. Victor has just missed a loan repayment, but because he's had a salary date change. So it's not a payment issue or anything of that nature. He just forgot generally, and his loan value is about 20,000 Rand, quite a low value at the moment. Contrast that with Sarah. Sarah is a high-risk customer with a high-value loan that she purposefully intends to not pay back. Sarah is very used to dealing with collections agents and agencies. She's got a couple of numbers and addresses that she cycles through. She knows how to avoid the calls and making promises, etc. She has also just lost her job. So if you take those two people and contrast them side by side, they are very different. When we follow traditional approach, what will happen is that we'll treat Victor and Sarah the same. So Victor has just missed a payment and Sarah is about to miss a payment, but they have landed at the same place from very different avenues. If we have a traditional approach to collections, we will bucket them the same and give them the same treatment. Lots and lots of calls and lots of nagging until we get a promise to pay. For Victor, that feels horrible. For Sarah, that doesn't feel like anything. That approach ignores their behaviors, ignores why they've come to where they are, and just results in irritation or avoidance, which is what we don't want. So what can we do to be more customer centric? So as I mentioned, instead of only asking what questions are typically how much money do I need to collect? And when questions are typically how quickly do I need to get hold of this person? When should I start calling them? We pivot to asking why. Why questions sound a lot more like what is driving their behavior? What clues have they given me? What data do I have about them that can give me the insight that I need as to what they're going to do next or why they've landed up where they've landed up? And we can ask how. How questions sound like how, given the information that I have, can I best respond to this situation? Can I create a treatment plan or an approach that works for both of us? It is that slight pivot that allows us to become much more customer centric. So if we apply the new frame of reference, that allows us to shift our perspective in a very easy to understand way. So we move from Victor and Sarah are both cycle 1 delinquent customers, we need to call them as soon as possible, to Victor is actually low risk and he's got a low value at risk. He's both willing and able to pay. All he needs is a low touch intervention. Contrasted with Sarah, she is high risk and high value at risk. She is unwilling and unable to pay. So she needs a much more aggressive approach and it needs to be much more immediate. If we focus on customer personas using these type of analytical tools, it allows us to make very small changes in terms of tilting our approach, tilting our scripting, changing the treatment path, but they become very powerful and they feel very empathetic for our customers. And what we've seen from the research and the tools that we've implemented in the market, these have been designed to land at specific stages of the collection cycle. And I've given you a high-level map here. This is by no means the only approach, but just to give you an example and food for thought around what could work and what tools are available from Experian that can support you in designing a customer-led journey that is persona-based. So if we start on the left, some of the segmentation tools, which are highlighted in the middle, might be value at risk segmentation. So the more money I have to lose, the more intense my treatment needs to be. Persona identification, as we spoke about, that deals with behavioral data. A lot of us have got a lot of information about our customer. How do we bring that into our customer journeys? How do we make sure that we're using the information in a way that is intelligent so that the treatment plan feels specific and is also effective? We have developed an early warning score at Experian, which you'll hear another colleague of mine speak about, so I won't talk about it too much here, which then gives you a preemptive warning system. It allows you to segment out customers that you need to do something about immediately versus those who can move to low-touch channels, can be routed to your IVR or a bot or your app. They don't need to have your agents on board. And so we go through the processes and the stages. So this is just to give you a sense of the way that you should think about designing customer journeys and the effectiveness that they can have in your collection space. Moving on to the second aspect of the presentation, we're going to speak a little bit more about how, along with customer persona identification and the mapping out of customer journeys, some of the digital approaches that we've seen in the market and that are going to be forefront and put you as a lender in a position of strength when it comes to dealing with your customers. So all of us, as customers ourselves and as lenders, are very familiar with some of the pressures that our customers are facing. I've just given you some anecdotal evidence here and some of our NPS feedback, but all of us have experienced this. So it really is, a question of increased strain in the market. There is a higher cost of living. It just is more expensive to service debt. There is a recession. People are dealing with job losses. They are dealing with increased financial pressure. There are also stronger regulations in the market, which we as lenders need to be very aware of. Coupled with changing customer contact preferences, so many of us are on our omni-channel journey, we really need to be thinking about leveraging our digital channels in a much more intelligent way. So how do we do that? We as lenders need to then understand and adapt to customer needs. And it's better for us to do that obviously earlier rather than later. So stepping through the slide, we can see on the left, we'll start with what customers want. So given the journey that they've all been through with COVID, job loss, recession, etc., customers are very used to digital and self-service channels. And remember that as a lender, they're not just comparing you to other lenders. because everybody is app native, many people are very digitally comfortable now. It's not a matter of one bank versus another bank or one telco versus another telco. They are comparing the usability and availability of the tools and features on your app with every other app that they have. So you're being compared to Amazon and Spotify and Takealot, etc. So it's very important to keep that in mind, that the solutions designed should be holistic. We have given an approach here that is simple rather than complex, though I will show you some more complex options as we go. So again, customers are wanting a lot of digital options. They're wanting self-service. That is a big ask that we are seeing in the market, particularly in EMEA. This is now a product that has been launched and is doing very well. And they also want agency and control. So we've been through the importance of having customer journeys that are tailored. That is because customers expect empathy in their journeys now. So how do we cater for that from a lending perspective? Obviously, we've spoken about omnichannel. There needs to be a digital platform available. For those of you who aren't on this journey, this is something to seriously consider. And then we need to enable customer-led collection. So what we find from the research and from the test cases we've seen is that when you empower your customers and you give them a little bit of control, they respond to that very well. It makes them engaged in the process. They feel as though you are on the journey with them. There is a lot less resistance, and it results in them being a lot less likely to default in future. So what might that look like in terms of the digital platforms? This is obviously omnichannel, always on contact option. So this might be an IVR option in your call center, a bot on your app, or a virtual assistant. In terms of enabling customer-led collections, app and web portals work very well. So this could be something that you surface on your app or you surface via web that has user-led screens that allow them to move through the process along prescribed paths. Benefits of this are quite obvious. It is obviously future fit. So this is the way that the entire market is moving. It's going to be very late in the day to get on the bus when it's left the station. So earlier is better. And we do find, as I mentioned from the research, you have better collections adherence, your NPS scores actually improve, and you have better customer retention and fewer complaints. So those of you who work with complaints colleagues know that this is a big bugbear in their life. So what can we actually practically do to assist our customers? There are 4 recommendations that we've put together from an experience perspective. They move from 1 to 4 through lower complexity to higher complexity, lower flexibility to greater flexibility. So each of these is not going to be for everybody, but we'll chat about them here just to start the conversation and to give you some food for thought. So what we've developed are 2 products that I'll show you where they can be surfaced along this journey. The first is Experience Data Quality, which some of my colleagues will have a little bit more information around. And the second is Velocity and Trended Variables, which many of you are either using at the moment or have heard about. There will be a presentation on this elsewhere at the summit as well. So feel free to engage in that content. So starting on the left with number 1, the first thing that we need to think about is customer and contact information and contact management. The second thing is we need to enable customers to make immediate payments via secure link. The third thing is they need to be able to set up and manage their own payment plans. And the fourth option is that we can propose and control early settlements months. So this is customer-led things that you would surface on your app or web portal. And I'll show you visually what it might. So to unpack it a little bit more, in terms of contact information and verification and contact management, what you might think about here is the ability for your customers via app or web to update their contact information, provide marketing consent, and manage their channel preferences. So again, these are mapped to the actions that your collections agents are trained to do right now. Every single collections agent is trained to ask who the person is that they're speaking to, so they verify it's the right person, and they are trained to ask for an immediate payment. Those are the top 2 things that all collections agents must do on each call. If you can automate that process for the customers who are eligible, and we'll talk about how you determine that, if you can automate that process, it removes a lot of noise from your environment. It creates a very joint approach that feels to the customers as though you are working with them. So if you can get them to do their own contact management, you get better RPC rates. Obviously, they're telling you where to get hold of themselves and which channels they prefer. And you can open up your marketing pipeline as well. So they can opt in for consent where they might not have done that before. The second option that's good to think about here is the ability to make an immediate payment. So obviously this is surfaced via a secure payment portal on Apple Web, and this allows them to settle outstanding balances. So things to think about here, very importantly, this is not going to be for all your customers. Obviously this is ideal for low balance customers. If we think about Victor as the example, customers who prefer low touch, who are digitally native, very comfortable doing this type of a process. It's not something that you would want to step through with somebody who's not familiar with an online payment link process. resulting outcomes here are you do get better dialer penetration because these people are out of the queue. Your collectors can then focus on the guys who are really difficult and need a human conversation. Moving to options 3 and 4 along the scale. Again, these are slightly more complex with slightly greater degree of flexibility. Not for everybody, but we have found that they are very effective in maximizing actual rand value collected. So something to think about. So option 3, and this is where you can use our velocity and trended variables to help you with some of your predictive models or scores, is the ability for customers to set up and manage their own payment plan. So this is where you would surface an outstanding amount for them, and I'll show you what some of the screens might potentially look like. You would allow them to be able to determine their own terms and how much they can repay. So this is true consideration of the affordability from their perspective. This is a very, very powerful tool, but again, just to reiterate, it is not going to be for all your customers. It needs careful segmentation and monitoring so that you don't give this to a Sarah who, is not going to want to pay you anything back at all, or is going to want to pay you 10 Rand over 100 months or 1,000 months, whatever the case may be. That is not what it's for. And then the last option, which is the most sort of high risk, but also can be very high impact, again, requires very careful consideration. This is where you would need to think about your risk appetite. But if you can surface to your customers who you know are never going to pay you, they're going to get to the end of their cycle and just have accrued charges and be more and more in delinquency, and you're going to have a harder time getting any money at all. For those customers who are really sort of no hope cases, as we tend to call them, it is much better to surface an early settlement offer very early on in the process and for a much lower amount. So there requires a high level of comfort around the impact from an impairment perspective and from a risk perspective. You also need to be very clear on your behavioral segmentation so that you target the correct people. This, again, is not for everybody, but we have found from evidence-based use cases that we've seen that it is very, very effective. So if you think about what some of the possible screen views might look like, and this obviously has to be custom designed for you, your brand, your customers, but it would be something like this that is very, very simple. And at Experian, even though there's a lot of analytics behind this, we like to be very cognizant of UX and UI for customers. So the proposed views here are our proposal. Again, we can work with you to think about the things that can and can't be surfaced, the data that you do and don't have available, pardon me. But this just gives you an idea. So you would want a screen that shows that your customer everything that they have in your universe, give them the option to make an immediate payment that talks them through the steps, and confirms for them that the payment has been made. Obviously, you would need a link to your payment provider. The same thing for payment arrangements, to update their information, etc. So if you have a look at this visually, it's quite simple, very easy to understand, quite intuitive, but the data that goes behind the flows for these screens. So if you have a look at the payment arrangements, you really need to be giving them simplistic understandings of, do you want to make a single PTP? Do you want to make multiples? Which dates do you want? You've got to be able to send them a confirmation that it's set up. You need to then use that information to feed back to send them a reminder that it is due. So this is just kind of a visual representation of all the steps that we've spoken about. So that is it for the presentation. I really hope that you all enjoyed it. If you do have any questions, please feel free to pop them in the chat and we will address them there. And I really enjoyed chatting to you guys today, and I hope you enjoy the rest of the summer. Thank you.
Hi, everyone, and welcome to this Experian Innovation Summit. My name is Koke Jorakopo, and I'm a senior regulatory consultant at Experian Africa. Today, I'll be taking you guys over effective IFRS 9 impairment modeling, and this is very important in turbulent times, such as the economic climate we find ourselves in right now. So, for our session today, we're going to kick off with a brief introduction, and we'll look at the common approaches that people use in terms of the model for the expected credit losses. We'll also look at staging, which is a very important part of the IFRS 9 framework. And then after that, we'll look at how do you determine lifetime for products that maybe don't have a fixed lifetime. And after that, we'll consider discounting for the time value of money. And finally, we'll bring it all together by looking at forward-looking information. This is on using economic variables to try and stress your portfolio. All right. So the IFRS 9 standard covers three main areas, which is classification and measurement of financial instruments. It also covers impairments, which will be our focus for today. It also looks at hedge accounting, which is, we're not going to be looking at that for today. And yeah, the standard came into effect in 2018. And, we've had some couple of learnings from the COVID-19 period, and we'll touch on those as we go through our presentation today. All right. So the main approach or the main idea with the ECL modeling, or at least the innovation that comes with IFRS 9 over IAS 39, is that, at this point, we try and calculate the expected credit loss compared to IAS 39, which are actually focused on the actuals, focused on the actual losses. In this framework, we look at the expected. And, given any portfolio, there's some losses that may be unexpected. But for those that we expect, given we've scored our base and we know what's the expected default rate, we can calculate expected credit losses for such a portfolio. And there's three main ingredients that people use. I mean, this is not the only way to do it, but this is the common approach that people take, and mainly because it yields fairly positive results or fairly accurate results. Okay, there's three parts to our calculation. The first part is the probability of default. Again, this is a topic that's very well documented. People have been using it before IFRS 9 even, and people use it for their credit scoring and other decisioning in their businesses. And we'll look at a couple of use cases that we've worked on at Experian. Also consider the exposure at default. And again, this is the EAD. This is, how much is at stake when when the client actually defaults, or what do you stand to lose, at that point of default. And lastly, we look at, your loss given default. Given default, some people do, pay you back, so you get some recoveries, and others you don't get recoveries. So again, you need to model that on your portfolio and then put these ingredients together, and you get your expected credit loss. And then we use discounting to try and bring it back to the reporting date, whatever date that you are reporting your results. All right. For each component of our ECL model, there's different approaches that one could use depending on data availability, depending on capability of your system also. So for the probability of defaults, if you don't have enough data, maybe you just kicked off your portfolio and you don't have enough data points to model your own book, we could use benchmarking process by going into the market and looking at what portfolios are similar to your portfolio, and we use that to try and calibrate your model. Another approach would be to use survival models. This is where you use your Kaplan-Meiers, and we'll see an example in the next slide of that. Again, with survival models, you need to have a reasonably large amount of data, so it's very data intensive if you want smooth results, that is. Sometimes, there's a case of over smoothing, but again, we'll touch on that in the next slide. We'll also look at transition rates. Transition rates, you can have, time homogeneous transition rates, which are fairly, simplistic assumptions, or you could complicate it a bit further, given that you have enough information to look at, a time homogeneous approaches. And lastly, you can look at your vintage analysis. This is where you use run-off triangles. And the positive about run-off triangles is that, for people that are not into the detail, are not into the technical numbers, you can look at the triangles and see what the model is doing. So it gives you a very nice visual assessment of your model as you run month on month. When we move along to the LGD, again, you can use benchmarking when you don't have the data, or you could also use competing risks in terms of the framework to try and estimate your LGD. Again, you can use run-off triangles again, where you calculate your recovery rates, and you use the run-off triangles. And again, the positive with this is that you get to see your results. And lastly, you could also use survival models to try and estimate your LGD. And then for the EAD, you can use benchmarking, again, data availability if data availability is a problem. Or you could use runoff triangles again, where you have a visual assessment of how your exposures move over time. And an important consideration in terms of the IFRS 9 framework is the idea that you need to identify a significant increase in credit risk. Again, for the environment that we're in right now, you could use quantitative measures where you look at the PDs, and we've seen in the market that PDs are going up. Or you could use qualitative, thresholds. This is, where you look at a flag depending on your client's behavior. I think debt review as an interesting topic for qualitative thresholds at this point. Right. So, most of the discussion around IFRS 9 is very high level. So we thought we should bring the details closer, and we look at a couple of examples of how one could employ, the different modeling frameworks. So if we look to the left, we have the blue and the purple curves there. So the purple curve is the homogeneous Markov chain model. This is a very smooth model. Again, it makes sense because you calculate one transition matrix, and there's an example there just below the graph. And then you multiply it by itself to get the cumulative default rate as you go until the however long your portfolio is. And the nice thing about this is you can take your transition matrix as is, and you can calibrate it in such a way that it matches your actual default rate on your portfolio. Another way that, once you have the model that say, the implemented solution for you is the homogeneous Markov chain model. Again, it's fairly simplistic. And the reason you would want to use it, is because maybe you don't have enough data to use a time in homogeneous model where, you calculate a specific matrix for each point in time. So you just assume one matrix and you take it, till the end of the life. But again, it depends on your portfolio and whether you have data for that. And we used, so for this portfolio here, we used the Kaplan-Meier, approach, or Kaplan-Meier model, a survival model, to try and, sense check our implemented solution for the Markov chain. So how does it hold up, compared to a Kaplan-Meier? And again, if you look at the same data, the homogeneous Markov chain model is fairly smooth. It's fairly smooth. That's the curve that's fairly smooth on the left. And the blue one is fairly kinked, and that is because we didn't have sufficient data for this portfolio. But again, it gives you an idea of, is that Markov chain model in line with other techniques? It would be very surprising for the same portfolio for the lines to be completely separate. But again, at Experian, when we do a calibration, we'll also test our alternative approaches to try and see if whatever model that you have implemented actually holds up in other frameworks. Again, we could have possibly smoothed that curve. So the blue line could have potentially been smooth. There's multiple smoothing techniques. Or we could have used another approach. We could have used Cox proportional hazards to try and, sense check the curved line. But in this case, we just stuck to Kaplan-Meier. Again, it's very important for you to have, as a portfolio manager at least, or as a risk manager, to try and, sense check the model that you're using. Does it hold up in other frameworks, or do you get completely different results? Given that the experience is the same on the book, you should be getting results that are fairly in line. And on my right, we have the recent default experience. Again, this is an example of how the market is looking currently, with the blue being the calibration at the end of last year, and purple being the recent calibration in the new year. And we see that, defaults have been going up across the market, and even in the parameters, it does show, the curve has shifted significantly up. And I think a couple of players in the market have shown, increase in impairments across the board. Again, with that, LGDs have also worsened due to recent trends of debt review, where, and we'll touch on this when we look at staging. And also you get lower cash flows from your clients. Exposures at default have also increased, which results in high ECLs across the board. So all these three parameters are sort of nimble enough, to capture the experience as your portfolio moves through the market. And to just bring it all together, so that was just the focus on the PD, just to look at how, you could sense check your results, or you could sort of back test your results. So when you look at the overall picture, so this gives us a nice summary of the whole framework. where, for an account that is in stage one, these are classified as performing loans. We calculate the 12-month expected credit loss. And for this, you use the 12-month probability of default, and you use the 12-month EAD, and you use the performing LGD. And for people that are in stage two, these are the people where you've seen a significant increase in credit risk, and these are the guys that are underperforming. For those, you use the lifetime ECL and the lifetime PD, and then use the lifetime EAD, and then but you still stick to the performing LGD because they're underperforming, but still there's some performance. And lastly, for stage three, these are your non-performing loans. So generally, the guys that are in here are 90 plus in default. And for these, you use the non-performing LGD while sticking with the lifetime metrics for the other inputs. And at the bottom there we have how we bring all these ingredients together, where we look at the exposure, the probability of default depending on your stage, your EAD given your stage, and your LGD given your stage, and then you account for the effective interest rate there at the end. Another important consideration when it comes to IFRS 9 is stage allocation. And, one needs to look at their portfolio and look at, the current performance or the current trends on the portfolio. So what is happening? And we've seen from a previous presentation with a colleague that debt review is on the rise, in the country. So, does your model capture that, or does your current framework capture that? And how one could incorporate that into their model is to look at, to define a qualitative default trigger. So this is where you look at, have a way of flagging clients that have went into debt review. And for that, for those clients, we move them from stage one to stage three. So that is the overarching arrow that moves from stage one to stage three. Again, if this is something that you didn't necessarily, consider previously, maybe it's a possible enhancement on your model, given that we've seen an uptick in the number of debt review cases. Another important consideration is to look at how do you define your significant increase in risk trigger. Again, for different portfolios, this will differ. You can define an absolute cutoff where you say you have if the PD increases by 30% or 25%. Or you could also define a relative measure depending on how low your PDs are and how high your PDs are. If your PDs are fairly low, you definitely want to put a hard cut off. But if your PDs are fairly high, then maybe a relative cutoff would work better in that scenario. Again, you could also have restructures where you move people from stage one to stage two because they've restructured their product. But again, the default one in terms of increase in credit risk is when a client is 30 days past due. That's generally what drives people from stage one to stage two. And, we have seen quite a number of movements from stage one to stage two over the past couple of months. And that's mainly because of, clients being stretched in this economic environment. Again, one can move from stage two to stage three. And this is generally, because of a default trigger. Again, the general consensus is that 90 days past due is the default definition to use. But again, you can interrogate it on your portfolio, right? You can definitely look at your definition of default and enhance it, based on how your book looks. You could also use qualitative default triggers there, or you could, restructure the stage two account and then move them to stage three. And once somebody is in stage three, if they stay, 90 days past due, they still, stay in stage three. And should they have a restructure, they stay in stage three. At this point, you are, calculating their ECL based on lifetime measures. So there isn't more that you could potentially, add to it. And once, depending on your write-off policy and how you've calibrated your write-off point in your business, generally accounts that are in stage three are likely the ones that are written off, where maybe, your write-off event is that you consider people that are, past 360 days to be a write-off, or there could be some qualitative write-off trigger that you have in the business. Again, clients are allowed to cure. So, you can move from stage three to stage two, but, to avoid having, multiple movements where your portfolio, is going up and down, we generally impose a probation period where, once somebody does cure and they go from stage three to stage two, you keep them in stage three, maybe for 6 months, or for 3 months, depending on the term of your portfolio potentially and other factors. And similarly, from stage 2 to stage 1, you can impose a probation period for somebody to stay in stage 2 until they move back to stage 1, because generally the coverage ratios, so your impairment divided by your balance, is generally quite different between the different stages. And you want to be fairly certain that if you're providing for somebody at stage 3, that is the appropriate stage to provision for that person. Again, in terms of stage 1, these are good performing clients that can stay in stage 1 the whole time. And if they get to the point or they pay off early, you can settle them as good, and that is the sort of the cell at the bottom left. So generally, that is the sort of staging that occurs on the IFRS 9 sort of framework. And it really depends, and you want to be sure that your staging works and it's appropriate for your portfolio. I mean, again, you can backtest your portfolio to see if your staging does work. And similar with your significant increase in credit risk triggers. So if you have a quantitative cutoff, you can perform hypothesis tests to see is this cutoff still appropriate for our portfolio, or maybe we need to adjust it and take it a bit up based on our experience on the book. All right. And now we've spoke a lot about calculating the probability of default over the lifetime and the LGD over the lifetime, or even the EAD over the lifetime. And some products don't have a fixed lifetime. So for such products, we actually calculate the behavioral term, and this is by looking at the contractual term and the behavioral lifetime and seeing is this the right sort of term to use as a lifetime? Because some products, even though they do have a term, they might go over term, and this is somebody who at the end of their term they're still paying off. It's just that their pay rate is not necessarily one that actually closed off their products. Again, for somebody that goes out of term, they generally provisioned at stage 3 because they are considered a default. Depending on your portfolio, you could classify them as stage 2 and have the numbers to show that these guys are actually still performing fairly well. And again, the behavioral term is configured for, generally we configure the behavioral term for credit cards, all those products that don't necessarily have a fixed term to them. But if you do have a contractual term, we generally use that as your lifetime, unless you go out of term, and that's when we'll consider using a calibrated behavioral term. All right. And another important consideration is discounting. I think with discounting, it's very easy to analyze and to sort of see the impact if one uses a cash flow model. But again, you can still see the impact even if you're using the PD, EAD, and LGD framework. So the effective interest rate in this case, you've estimated how much you're going to lose, the scale of it, and what is the probability of that event happening. And now we need to discount these cash flows to bring them, to the current reporting date or the current time, right? And generally, this effective interest rate needs to be fairly calibrated, because if you don't, if you underestimate the effective interest rate, you run the risk that you overstate your expected credit losses. Or if you overstate it, you run the risk that you will understate your expected credit losses. And the downside with this is, when you do get to incur those losses, they may be fairly different to what you have provisioned for. And, that's not a good place one should find themselves in. Right. Cool. And now we look at the forward-looking information aspect of the IFRS 9 modeling framework. So in this part of the modeling, lifetime, this is where we look at economic data depending on where you source it. And then you sort of, predict different economic scenarios. It doesn't have to be 3. Can it be multiple? Or you can have, a fairly extreme case and attach a fairly small probability to it. And I think a lot of, practitioners did this during the time of COVID, where, you define your normal 3 scenarios, but you have that extreme scenario where you attach a fairly small probability to it. But just to say, we have considered that risk of, things going really badly, even though, it is fairly unlikely. So you can test the 3 different parts. So we can definitely test, stress the PD, LGD, and EAD. And generally here, regression based models are used to try and stress the different components. And this is where, we then link your different parameters on your FS9 framework to the economic data. So how does your PD look in the stress scenario? How does your LGDs look in the normal scenarios, and how does your EADs look in the favorable scenarios? And we generally attach a weight to each scenario. So an example that we have on the right is where you stress your PDs, and you have that. Oh, it doesn't have to be PD; it can be any FS9 parameter for that matter. We look at the stress scenarios where we attached weight of 15%, and then in the normal case 55%, and in the favorable case 20%. And generally, when you get these economic estimates from whatever supplier, they generally provide commentary on the different risk, and they will give you the different weights that they believe are appropriate for their model. Again, you don't have to commit to the scenarios that were provided by the supplier. You can make the call as management to say, what, given the parameters that were used in this regression model, we believe, PDs are fairly stable in all economics sort of scenarios or instances, and you attach the appropriate, weights into the parameter. Once you have, all those weights that are attached to the parameters, you can then calculate the ECL under each scenario, and then you can, put it all together by calculating the weighted ECL on your portfolio. And the nice thing about this is it's a fairly straightforward, and you can revise it, fairly frequently and calibrate it just to see, how is your book performing. And from 1 year to the next, you can actually look back and look at whatever model you used in the previous year and whether it was appropriate, or there's maybe possible enhancements that could make the framework even better for your portfolio. All right. And now we bring it all together. So we look at all the different parts that we've been discussing up to this point. And as Experian, maybe we can look at development. We can, build the database for you. We can definitely estimate the 3 parameters that we spoke about. So your PD, LGD, and EAD. Again, that's not the only way to do it. So we have, built cash flow models as well. If that's the preferred approach for you. And again, the positive with cash flow models is you are able to see the cash flows and maybe just check if the appropriateness of the cash flow model. It also provides a way to go back and look at whatever cash flows that you calculated and what actual cash flows actually played out on your portfolio. That's the positive of using that framework. Again, once we have all these parameters calculated, we can then estimate your ECL, and this is the probability weighted ECL. So even beyond the ECL or the base model itself, we can build a FLI model for you, and we can give you the full picture of even including the FLI, what does your ECL look like? I mean, even if it's not development, once you have a model potentially that you have built in house, happy to have to do a validation exercise where we look at the data validation, whether the data makes sense, and we can also perform an independent model testing where we build a separate model altogether to see if your model actually holds up, or we get similar results. And if we don't get similar results, we'll be able to explore why that is and whether maybe there's some shortcomings in the approach or something like that. Again, it's very important in your IFRS 9 model to back test. I think this is the one key component of this framework, in that you're able to look back and whether your model is playing out how you sort of estimated that it would, right? And if you can take lessons from your previous iterations, then you incorporate it into your model going forward. Again, we also do benchmarking. One of my colleagues would have spoke about benchmarking in the different frameworks in terms of default experience on your book. So we can definitely benchmark your portfolio and see how it looks, compared to similar products in the market. All right. And in terms of implementation, we can definitely again build the data framework in house, and we can definitely interrogate the different modeling definitions. And it's very important because all of this is based on your default definition, right? So if you look at all the different metrics that we've spoken about. So you expect your exposure at default, based on, at what point do you estimate your default to be at, right? Your loss given default. Again, your default definition is very important there. I mean, even in the probability of default model, the default definition is sort of the central player into this whole framework. So it's very important to interrogate your default definition and whether it's appropriate for your portfolio. So we can definitely define that and test it and see if it is appropriate for your book. Again, once we have built the model and we're hosting it in house, we're able to you share the data with us month on month, and we build the model, we run the models for you, and we generate the ECR results and share that with you. Again, when it comes to audit periods, we definitely do audit support as well, to speak to your auditors, and if they have any questions on the model and possible enhancements and notes on the model, we're definitely happy to attend that with you, and we sort of build the model together. And lastly, in terms of monitoring, it's very important to monitor your model when it comes to IFRS 9, right? So how are your parameters moving month on month? So are your PEs going down? And if they are going down, why are they going down? And is this also in line with the experience, in your internal, reporting frameworks, right? So it's not enough for us, to say the default rates are increasing in terms of IFRS 9. But when you look at, your normal acquisition reporting, you don't see defaults going up, because then there's a misalignment between, whatever is happening on the acquisition side and what is being done on the IFRS 9 side. So it's also very important to keep your default definition consistent, such that all these trends that you see in your acquisition space, you can also confirm it when you look at your IFRS 9 numbers. Again, we can look at the parameter performance. So are the parameters fairly volatile? I mean, this is a number that you don't want to, be, fairly volatile. You want it to capture the experience of your book, definitely, but you don't want it to be fairly volatile, because then, come financial year end, you're expecting a number in the 60s and now it's up to the 80s. And I mean, this goes directly into your bottom line. So you definitely want to see how your parameters are performing. And again, you could also do stress testing, so when you look at, we discussed, the effective interest rate in the previous slide. So shifted up by 200 basis points, and also shifted down by 200 basis points, and see how your model responds to these different stress scenarios, because then that will tell you, your weak points or the weak points of your model. Again, we can look at the impairment. So how's the provision number moving from month on month? Is there seasonality in it? So sometimes these trends you're able to monitor. And when you see an increase, in December or in January, that, this is a seasonal component and it should normalize in the next couple of months. So again, this gives you an overall picture of, your model and what we could potentially work with you to sort of, build or sort of optimize your IFRS 9 model. And that is me for today. Please, if you have any questions, feel free to post them in the chat and we will get back to you shortly.
Hi, my name is Lauren Esterhazen, and I'm the Portfolio Analytics Manager in the Decision Analytics team. Today, I'm going to take you through enhanced predictive modeling tools. The two tools I'm going to demo for you today is Modeler and Convex, and then I'll do a quick recap at the end, and then we'll open up with questions. Firstly, I'm going to demonstrate Modeler. If I was to summarize Modeler in a few sentences, Modeler is an excellent tool for logistic regression models. It has a built-in feature reduction and a great auto-binning tool. Modeler can be used for advanced models that include reject inference and even non-take-up inference, to a quick and dirty model for a POC. In the more recent years, Modeler has introduced some machine learning techniques, namely random forest and XGBoost. And the latest addition is an open source Python node, which will allow you to bring Python straight into your tool. I will now demo the tool in screenshots and highlight the best features. I'll be following the process flow of building a model. So I'll be going from importing data all the way to documentation and deployment. Here's just a summary of the techniques that I described just now. I will go into more detail as we go along. When you open Modeler, you have the option to start a new project. You have the option of a blank template or a few of the built-in templates. The built-in templates are great to use. So you have the option of a behavioral or an application model. You have the option to include field reducer. Then, if you want to include reject inference, if it's an advanced application model, and if you want the non-take-up inference as well. Once you have chosen your template, then you will need to import your data. The options of sources is SAS, SQL, and Excel. And then from there, once you've brought in the data, you want to look at your data. So here's the data analysis tool where you can see the distribution of the different characteristics. And here is a population overview. Once you've added population splits, then you can pull a population distribution chart. Okay. Based on the project template you selected on the previous slides, Modeler will have pre-set up fields. Here is an example of an advanced model. You have accept reject in here. You have the good and bad definitions, as well as take up and non-take up. And here's an example of what the coding looks like, which is very basic to pick up. One of the great features of Modeler is that any of these standard variable codes you can add to your library and just import at every project. Once you have imported your data, defined your target fields and population, then we need to reduce our fields. This process is an automated process, which reduces your fields based on thresholds you give it. Field Reducer removes fields with little discriminatory power based on your Gini or your information value. Then it removes highly correlated fields based off your 60% criteria or whatever you have. Then here's an example of the parent-child relationship. Like all modeling tools, this is just a start. You can override at any point. So this CRC percentage trades utilized greater than or less than, 75%. It is correlated with 9 fields. You can see the correlation here, all above 60%, and the univariate Ginis. Modeler has selected the CRC percentage trade as the best field, and you will not lose any information. I'm going to reiterate again, from here, you can override the tool. From Field Reducer, we would want to jump into the fields themselves. We want to understand what we are feeding the model and look at the trends. So we pull it into the auto grouping tool. Here is an example of a field. Here is unsecured number of trades in the last 90 days. You can see from the colors, the more trades, the higher the risk. So for this variable, you can now adjust your bins or keep it the same for a quick and dirty model. Here is it as a weight of evidence chart, if that is easier for you to bin from. And there's a few other pictures here on a different characteristic, namely the PRISM, so one of the bureau scores. So here is sigma RC, and you can also group according to this graphical representation. These pictures are to highlight that the tool makes it very easy to visually see the high-risk bins and the low-risk bins, and easy for you to adjust the binning. Additional features worth highlighting under the auto grouping tool is that you can right-click on a field and you can duplicate it, and you can adjust the binning and compete and compare those two different binning options in your model. See which one works best. Then you're allowed to add special cases. This in our area we mainly use for default fields in our bureau field. So for example, a -9 would mean no hit. Then the next option is a cross characteristic. So if you have a big chunk of volume in one bin, cross characteristic is a good addition in this tool. Another great tool is a cross characteristic. If you have a big volume, a big amount of data in one bin, you can cross tab it with another field, which will allow it to spread out the binning and help for a more detailed score split. Then this is another option. You can always override the auto grouping. This tool here on the right hand side is you can right click and override the auto grouping based on the split in the population. And then any of your bins can be added to your group library and applied in later projects, which helps a lot. Once you have prepped your data, now is when model building starts. I'm going to just highlight the different techniques available in Modeler. So we have logistic models. So here you can see the options of weight of evidence, regression, the adjusted version, reweighting, so just highlighting the ones we mainly use. Then linear models has the same options, just linear models. Then we have decision trees, which is CART as well as CHAID. This we use mainly for segmentation testing, but you can also use it for a very simple decision tree model. Then we have ensemble models. This is the machine learning models. So these are supervised techniques, and it's random forest and XGBoost. And the latest edition, which is the open source node, which connects Python straight into Modeler. Here's just some additional things to consider. You know, you can always create multi-stage models. You can model continuous variables like predicted income. All of that can happen in this tool, and segmenting and joining your models. Here is just an example of what the output looks like for a CHAID tree. Here is a small snippet of the model logs in logistic regression model. Here, you can either have a quick summary log or an advanced summary log, where you can see, if you were to select a stepwise regression, you can see every step of the process. Here is what a scorecard would look like in a logistic regression model. And this is based off the scaling that you set up before running the model. A correlation matrix and the thresholds, which can highlight high correlated fields or any fields close to your threshold. When building your models, you would usually jump into validation, but sometimes there is a step in between if you are building an advanced application model, namely reject inference. Reject inference allows for a more robust final model. and reduces the bias that creeps into the model. In theory, when I look at this, you can extend your known good-bad model to your rejects. You can penalize them by reducing by constant value, but you can also use multi-dimensional parseling. Modeler has this option, this great option in the tool. So here's just what the properties would look like. And what this means is a combination. It's using your known good-bad model and your accept-reject model. And you play around with the power that you put on it. So your rejects that are closer to your known population will be less penalized than the ones further away. Okay, so here is what an output would look like once reject inference has been run. Here is one reject, consumer, and then the probability of that consumer being good, bad, which will equal your take-up, and then the non-take-up. And this is the multidimensional parseling. From your model build, that is when you start validating your model. To validate your model, you'll need reports. Modelers' reporting capabilities have really no end. There are some standard built-in reports, and then you have a blank canvas to develop your own reports as you go and add to your library of reports for future use. Here is an example of the library that we have added. So there's reports for known good, bad, reject inference, final models, and this is what it would look like in the tool. You would drop a report, link it to the model, and run your report. This allows for all your reporting to be consistent and neat and assists you doing quick checks as you validate and tweak your model. Here are a few examples of visuals that we have created over time, and the possibilities are really endless. Here is a Lynn Goodbad odds chart. Here's Gini chart, then Gini over time. Then we have the weight of evidence on a characteristic by the bins. So here with the different colors, you're comparing the known good-bad model against the accept-reject model, and then the final model once you've included reject inference. Here is just a simple bad rates by decile, comparing your old model to new model. And then here is a characteristic field over time and the stability. So the yellow line here is the stability over time. So really, there is no end to the reporting capabilities. It has standard built-in measures, so PSI, Gini, information value, VIF, and chai tests are built in. This will reduce your documentation time hugely. Here is an example of what the reports look like with the ensemble machine learning models. So here is for the random forest technique. You will see the SHAP summary plots, you see the SHAP importance graph, and you see the Gini. Now, these are just the standard reports. You can build your own reports and link it to any of these objects. Once you have validated your model, you will now probably jump into documentation. Modeler makes it very easy to do that. There is a Word add-in, Excel add-in that speak to each other seamlessly, or every object you can right-click and say add to documentation, and then you can print your documentation from there. Also, here is at the point where you would export the scorecard code into SAS or SQL. So just to recap Modeler. Modeler is an advanced logistic regression modeling tool. It has field reduction. It has a great auto grouping and binning tool. Reject inference is a built-in, very customizable reporting. There's machine learning techniques, very transparent and continues to advance. And then there's great support and training locally. Next, I'm going to jump into Convex. Convex is a machine learning tool which is aimed for the smaller analytics teams who do a lot of POCs. This tool specializes in machine learning techniques and clustering. On the traditional model side, like logistic regression, convex is more suited for basic or standard models. It does not cater for reject inference, and it has a basic field reduction tool and a very different binning tool. On the machine learning side, the options are wide. Convex allows for very detailed parameter tuning and will find the optimal parameters for the best outcome. Convex also makes it easy to compare different techniques side by side simultaneously. So I will demo the tool in screenshots and highlight the best features, similar to what I did with Modeler. Similarly, I will follow a process flow of data prep all the way to tuning the model and deployment. Here is just a summary in advance of what the techniques Convex covers. So first, once you've imported the data, the tool has immediate options of visualizing your data to identify any quality issues. The visual options here are extensive in Convex. Examples are distribution plots, violin plots, correlation, and heat maps. Why would you need so many options, you ask? Well, everyone has different preferences. I'm going to go into a little bit of detail with the different plots. So we have distribution plots, which depicts the variation across a continuous variable. We have the box plot, which is looking at the 5 main statistics. We're looking at the minimum, the maximum, the median, and then the first and third quartile. So you can see with age, the data is around the middle age group. Then if you're looking at the stability, the probability plot, so you can see whether the variable is, how skewed the variable is, and possibly at a later point can tune this field. Then there are violin plots. This is very similar to the distribution plot, just on its side. Then there's categorical fields. This is a distribution plot. And then the correlation matrix, which is bright and colorful with the heat map. So there really is graph for all preferences. So once you have looked at your data closely, now you possibly would want to do some data cleaning. So the options here are data transformation, where you would possibly change your characteristic fields to numeric fields. You can engineer new fields. So as you can see on the right-hand side, it's very, very familiar to most of you if you use Excel. Then you can handle missing values. You can either substitute it with the mean, the median, a constant, or a default code. And then we have scaling. So this is for normalizing or standardizing any of the fields. And then there is binning. Okay, so this binning is not a complex binning tool. You are binning it by number of buckets. So it will split in 10%, for example. And it is recommended to bin outside the tool. From there, you would want to reduce your fields. Convex has built-in rules, and the results are represented with colorful bullets like a robot: green, yellow, and red. The 3 standard rules that are built in is the duplication rule, where variables with the same values are highlighted in red. Then there is a constant rule. This is where the raw values within the field has very little variance, and that will fall in the yellow and the red. Then Convex applies correlation. Many fields are often correlated with each other and hence redundant. Convex uses Pearson correlation coefficient in the back end with a threshold of greater than 90 being red and between 70 and 90 being yellow. From there, you can decide which fields you want to reduce. At this point in the process flow, this is where you would select your machine learning technique. there are 3 different types of options. We have classification, regression, and then clustering. So in classification, this includes supervised techniques. So this is like machine learning modeling, linear models, and traditional logistic regression. You can see here's where XGBoost, random forest, CatBoost, and light GBN is available. Then you have regression. This is for continuous variables. When you select the type of problem you are dealing with, you can split your data within Convex, and you also have full control of the balance across these sets. There's different strata options. The options are random sampling, weighted sampling, k-fold cross-validation, under and over sampling. Then we jump into the clustering option. Convex has dbScan clustering. This technique is great for identifying nested clusters. So something like the FAS in our area, or to split up your population. But this technique is great at identifying outliers that you can remove from your data. Once you have selected your technique, Convex has the flexibility to tune and find the best combination of hyperparameters that results in the highest accuracy. So from all these options, depending on what you select, you can adjust the thresholds like the learning rate, the number of iterations, the leaves. It's really, all the options are there. And then Convex uses grid search method in the backend to consider all parameter combinations to find the optimal combination. Once you have run your model, you will see this picture. It's basically the log in the background. At the end of the modeling process, you can compare techniques against each other to identify which techniques will produce the strongest results. So here you can see it will highlight the strongest. Here's just a visual. Once you have run your model, you want to look at the reports. You want to compare the strength of the models. You have the rock curve as an option. You also have the importance of the variables. Then you have the confusion matrix, as well as the recall curve. And then a great addition is SHOP summary plots. Here is an example of an output, and this is great to understand the explainability and transparency of your fields. To recap Convex, Convex is user-friendly with no code required. It has easy data visualizations. It's on a highly secure online portal. The advanced machine learning techniques and parameter tuning, standard reporting setup, dbScan clustering is a great addition to this tool. Now I'm going to recap the two tools next to each other. Modeler is an advanced logistic regression modeling tool. It has field reducer, auto binning, reject inference, custom capabilities of reporting, and no advanced code experience needed. Convex is very user-friendly and will take you step by step through the process. Easy visualizations, highly secure, advanced machine learning, standard reporting setup, and then the dbScan clustering. If you have any questions, please add them to the chat panel and we will respond shortly. Thank you for joining me today.